we are continuing on with Chapter 5, talking about food tax and student tax. Left off on Thursday before talking about what happens with interstate employees. So obviously we have employees that will work in multiple locations. Since student tax differs with regard to what the wage base is and the rate, the tax rate that's being charged, it's really important to determine exactly where that employee is, where they're subject to tax, right? So which are, like in the example of the employee that lives in Davenport and works in Illinois, or maybe they have an office in both Davenport and across the river in Illinois, where do they pay, where does the SUTA tax apply? So we've got four different word I'm looking for is, I've lost my train of thought. So four different, I want to say categories, but they're not categories. Anyway, four different things that help us to determine where that employee is subject to SUTA tax, and they apply in this order. So the first one, where the work is localized. So if you can determine where exactly the work is done, then, and it's just done in that one location, then you would go ahead and that would be the state that is used for SUTA purposes. If you can't determine that, what is their the base of operations for the company? So where exactly are, what is the company's base of operations? That would be second on the list. Can't determine that, then the location of the place from which operations are directed or controlled. So to determine, if where the directions are coming from, the supervisor and all of that. And finally, if none of those, if we go through the whole list and we still can't determine exactly which state the SUTA tax applies, then we would use the location of the employee's residence, finally. So there are these reciprocal agreements between states as well. You apply the order in the previous slide, and even if you by applying the order in the previous slide in the coverage of the interstate employee cannot be determined, then there can be an agreement between the states to determine where which state is going to apply with regard to SUTA coverage. So the employer can choose the state in which all services of interstate workers are to be covered based on the most advantageous wage base and contribution rate. So they can choose the state that has the lowest, it's going to cost them the lowest in taxes. Once that employer chooses, the employee has to consent to that as well. And then the state will approve the election of coverage. Now it's important for the employee because, as you saw in that list, certain states, the benefits are more generous than in other states. So the employee might not agree that they want to be in the state with the lowest tax rate for the employer. A lot of employees probably wouldn't understand that as well, or wouldn't be knowledgeable enough to make that educated determination, but the employee does have to consent to it. If the employee is transferred to another state, then the wages covered by unemployment compensation of the previous state are included by the employer in order to determine the taxable wage base. So in that case, example, you lived in Iowa, maybe you worked for, you worked for Amazon in Iowa for part of the year, and then you moved to Kansas for the other part of the year, still working for Amazon. We're talking about individuals who are working for the same company, but then transferring. That means that the employer can apply the amount of wages that were earned in Iowa to the Kansas wage base when that transfer, after that transfer occurs. So they're not doubling up on what they have to pay then to both states. So if the employee already reached the wage base in Iowa, then they would not be subject to additional SUTA for the rest of the year in Kansas or whatever that second state was. Now this only applies to employees who stay with the same company. If you switch companies, then that new company is gonna start all over, right, with the wage base and determining all of that. So, but there are, if we can't determine, like I said, through these four factors, that's the word I was looking for, these four factors, then a reciprocal arrangement can be made as well. So what about Americans who are working overseas? So sometimes they would be covered, sometimes they wouldn't be covered. If they are working for American companies, then they would be still covered by SUTA tax, even if they're working overseas. So again, Amazon, I'm sure they've got locations overseas. You're working for an American company, but it's overseas. Then we would use these factors to determine which state which state SUTA would apply. Even though you're working overseas, those amounts that you're earning would be applied to the appropriate state's SUTA. Employer's principal place of, usually it's the employer's principal place of business, what you're going to get to, because you know, if you look at these, so location of employees' residence, if they're overseas, then that's not obviously going to be going to apply. If the principal place of business can't be determined, and this is the business's principal place of business, then the state coverage is the state of incorporation of the owner's state of residence. So wherever that company is incorporated, that would be the determining factor as to which state's SUTA rates would apply. Okay, so just kind of some, and I'm gonna, so benefits, we don't really go into benefits here. I'm not real knowledgeable about what the benefits are, and again, that would change from state to state. We took a little bit, a brief look at the chart that is in your book that just showed what the maximum was and what the minimum was. I don't know what the calculation is for benefits, but usually there is a minimum base, that lowest base period wage, and then that maximum as well. Sometimes there's a waiting period, sometimes there isn't a waiting period, and then there's a maximum number of weeks that would apply. So let's kind of take a look at this. I do want to use this example to review the state that would be determinant for SUTA purposes. So we've got George. George is a resident of Arizona. So he lives in Arizona. Works as a marketing executive in a cell phone manufacturing company. His job requires him to travel and perform services in Illinois, Michigan, Arizona, and Ohio. His work is equally divided among the 4 states. He receives instructions from all 4 locations, and the business records are maintained in Ohio and Michigan. The operations of the company are controlled from the offices located at Illinois, Michigan, and Ohio. Which state is George covered under? So let's go back to the 4 factors here and go through them one by one. So the place where the work is localized would be the first determinant. So his work is equally divided among the 4 states. So we don't really have one location where the work is localized. So we're going to have to go to the next factor here. The location of the base of operations would be next. Let's see. Business records are maintained in Ohio and Michigan. So, the operations of the company are controlled from the offices located at Illinois, Michigan, and Ohio. So we still don't really have any determinant location where that would be, where the location of the base of operations are. So the location of the place from which the I guess I just did this one, where the operations are directed or controlled. So let's go back to this base of operations. Receiving instructions from all 4 locations. Business records, I guess that would be the base of operations, are Ohio and Michigan. So now we don't really know whether it's Ohio or Michigan. Operations of the company are controlled from the offices located in Illinois, Michigan, and Ohio. So that third factor, location, for which we really don't have one particular location where that is the case. So we're kind of left with George is a resident of Arizona. The location of the employee's residence. that would be my assumption there, and that is the correct one. So Arizona, he's an interstate employee, works in more than one state. Because we can't determine specifically where the work is localized, the base of operations, or where the operations are directed or controlled from as far as one location, then we are left with where his residence is. So, just kind of the steps there. Any questions on that? No? All right. So let's get to the fun stuff. Let's start talking about how we calculate FUTA. So FUTA just like Social Security taxes, FUTA has a wage base. And this applies to everybody who is subject to FUTA taxes. So this does not vary from state to state. The wage base stays static at $7,000. So it's the first $7,000 of wages that are earned at any one employer. Okay, so that example of the employee who lived in Iowa and worked for Amazon, then was transferred to Kansas, worked for Amazon, that $7,000 applies to all those wages that were earned in both Iowa and Kansas. It doesn't start over again. If that employee though worked for Amazon in Iowa and then worked for, some other company in Kansas, then that $7,000 would start over again. Okay, so it depends on, you got to be careful to make sure that is it for the same employer or is it a different employer that is involved. And this is $7,000 of wages paid during the calendar year. So the $7,000 starts again January 1st, right? So the accumulation is from January 1st to December 31st. These wages would include bonuses, advances, and commissions, retroactive wage increases, tips, transfer of stock as part of payment for services. So the same types of wages, the same definition pretty much of wages that we had for Social Security and federal income tax purposes would be considered wages for FUTA tax purposes. That means the same exclusions for the most part would apply as well. So partners in a partnership would not be subject to FUTA taxes. Okay, any payments that are received by contractors, that's not subject to FUTA taxes. So we're going to use that same definition pretty much of what an employee is and how we define wages as well for FUTA taxes. And as I had mentioned here, so the wage base applies separately to each employer. So that would start anew. The tax is only paid by employers. It is not paid by employees. Now, it's probably paid by employees indirectly in the form of reduced wages, right? So anytime anytime an employer has an additional expense placed on them, that is going to overall affect what wages they can pay to their employees. But directly, it is the employer that pays these FUTA taxes. So again, it's only on the first $7,000 of wages. So some things that are non-taxable, advances or reimbursement for those ordinary necessary business expenses as part of an accountable plan. Remember we talked about that in the last couple of chapters. Retirement pay does not count. You're retired, you're no longer an employee if you're receiving that retirement pay. Educational assistance payments to workers, meals and lodging for the employer's benefit. So that very same list of types of remuneration that would not be included as wages for FUTA taxes. Okay, so again, tax rate or wage base, any base actually, we don't have to just say wage, base times rate equals the tax. So we've established our base, which is up to $7,000. So our rate for FUTA purposes, and this again applies to every covered employee who earns covered wages or covered remuneration in the U.S., the rate is 6%. So 6% of the first $7,000 of wages for each employee per year is the amount that the employer will pay in FUTA taxes. Now, 6% is pretty high. What they do is they give employers up to a 5.4% credit against that 6%, as long as they have paid their SUTA taxes on time, their SUTA taxes. So this is where those two taxes kind of work in combination with each other. As long as the SUTA taxes have been paid on time, and as long as the business is in a state that is not subject to a credit reduction. So, and I will tell you, this is where a lot of students get confused, is this credit. It can be kind of confusing because we usually think, well, credit's a good thing, right? You're getting credit towards something. It's going to reduce, obviously the 5.4% reduces our tax rate of 6%. So it can bring it down to 0.6% tax rate. But it can get a little bit confusing when we talk about a credit reduction, because that word reduction also kind of makes you think, oh, it's I'm the amount of tax I'm going to have to pay is being reduced, but that is not the case. For companies or states where there is a credit reduction, it means that this 5.4 is lower, so the actual tax rate is going to go up. Because the tax rate of 6%, here's our credit of 5.4, so 0.6%. But if this is reduced, this rate's going to go up, right? So let's say we had a 1 point reduction in our credit. Now it's 4.4. Now our tax rate is 1.6, meaning our tax is going to go up. So I just want to point that out because that is an area where a lot of students do get confused with regard to this credit reduction. Now, most employers and most states will receive the full 5.4 credit reduction, meaning for most employees, the tax rate is going to be 0.6% of wages up to $7,000. So if they make $8,000, $1,000 of that is not going to be subject to FUTA tax. Again, January comes around, and then we start at zero again. This is on a per employee basis. So when you're doing your homework problems, you're going to get a lot of homework problems where there are multiple employees. And you've got to keep track of how much employees have made throughout the year. Okay? Let's see here. We've got some examples that we can play with. So I kind of mentioned this earlier. So to get the full 5.4% SUTA credit, the employer must have made their SUTA, and they refer to it as a SUTA credit. It's a credit that you receive if you did everything right with regard to your SUTA taxes. Okay? Yes, it's a credit against FUTA taxes, but it applies to your behavior with regard to SUTA taxes. And I'll tell you the reason why in just a second here. Why, that makes a difference to FUTA. Why would the federal government care if you paid your SUTA taxes on time, right? And I'll get to that. So they have to have made their SUTA contributions on or before the date for filing, so it's got to be made on time. If it's not made on a timely basis, then the credit is limited to 90% of tax. Even if an employer pays into more than one state unemployment compensation fund, credit against federal tax is still limited to 5.4%. So that 5.4% is always going to be the maximum. So some states have a higher wage base than the federal amount. In that case, the SUTA contribution may exceed 5.4% of the 7% FUTA tax. But the maximum credit is limited to 5.4% of the $7,000 of the employee's earnings. So the reason why the federal government is concerned about employers paying the maximum amount into their state funds is because if the state fund comes up short, the federal government has to step in and cover the shortfall. Okay, so that's why this is to encourage employers to make those payments in full and on time, because so there's like a penalty in the form of a credit reduction, a reduction of that 5.4 credit, if they don't make that payment on time. So that is to encourage good behavior by employers. The second thing, in order to maintain the maximum credit of 5.4, the employer cannot be located in a state that defaults in its repayment of any advances. So this is a case where these advances, this is when the federal government has had to step in and make payments on behalf of the state because there was a shortfall in their state fund. The state then has to repay and is on a repayment schedule with the federal government for funds in that pool, or in that the amount that they owe. If they are in default of that, they don't make those payments on time, then that credit reduction is going to apply to every employer in the state. So even if you as an employer made all of your payments on time and in full, you had good behavior, if the state has bad behavior, you're still going to get punished, right? So that's the second factor in order to get that full 5.4% credit. That title, what is that, 12 of the Social Security Act, this is what authorizes the lending of funds from the federal government to states so that they can provide unemployment compensation funds. So again, this is, any credit reduction is essentially a penalty for bad behavior, for not making the payments on time and in full. In this case, the credit is reduced 0.3% per year beginning the second year after the advance. So if they don't pay it back after that first year, they're going to get, the whole state is going to have this reduced by 0.3 for every year that they're in arrears. Additional credit reductions are possible beginning with the third or fourth consecutive year in which the federal loan is not repaid. So let's look, do we have any examples on here? Let's look at an example. Well, let's make up an example then. They're not going to give us one. We'll just deal with FUTA right now. Let's say we have 4 employees. I'm not going to give them names. I'll just give them 1, 2, 3, 4. Quarter 1, quarter 2, quarter 3, quarter 4. In quarter 1, employee earned $2,000. Employee 2 earned $10,000. 3 earned $5,000, and 4 also earned $2,000. In the second quarter, let's just give them equal pay here. 5,000 and 2,000. We'll stop right there for right now. What you have to do is determine cumulatively have they reached that $7,000 point? If not, how much of their wages are subject to FUTA tax? So, for quarter 1, taxable wages, how much of employee 1's taxable wages are subject to FUTA tax? All of it, right, $2,000. Employee 2, how much of their wages is subject to FUTA tax? 7,000, right. Employee 3, 5,000. Employee 2, 2,000. So taxable wages for the first quarter, what do we have here? 7, 14, 16,000 in taxable wages. Different from total wages because employee 2 has exceeded already the $7,000 mark. So let's look at quarter 2. We have to add these quarters together to determine if they've met that $7,000 point. So for quarter, what are the taxable wages for employee 1?
2,000.
2,000, all of it. Right. But now we're up to 4,000, right? How much of the wages for employee 2? None of them, 0, right? Because they've exceeded. Employee 3? 2,000, right? Because 2,000 of this gets them up to the 7,000. They had 5,000 in the first, 7,000. So 2,000. And employee 4, 2,000. Right. So 6,000 of these wages are subject to food tax in the second quarter. Quarter 3, we'll just make this easy. 10, 2, 2. What are our taxable wages for quarter 3 for employee 1? All of it, right? 2,000. 0. 0, right? And again, all of it, 2,000. So now we've got 4,000 of taxable wages. Now we get to quarter 4. Again, same wages. I'm sorry, it's 5,000. And 2,000. I'm sorry, no, that's hard to see. How much of this 2,000 is subject to food taxes? 1,000, right. There are 8,000 for the full year, right? They made 8,000 in the 4 quarters. They reached that $7,000 wage base in the 4th quarter, but then they started to exceed it. So 1,000, nothing for employee 2, right? Nothing again for employee 3, and the same thing for employee 4. So 1,000 would be taxable. So you've got to keep track of how much the employee has made thus far in the year. So what the cumulative amount is during the year. Questions about that? Now it gets even more fun though when we start talking about SUTA, because now we've got 2 calculations. In this case, our wage base is set at 7,000 and our tax rate is set at probably 0.6%. But for SUTA, we may have a different wage base. So these wages, if maybe we go up to $8,000. Maybe our wage base is $8,000 for the SUTA taxes. And our tax rate is 5%. Right, so we've got to do 2 separate calculations based on 2 separate wage bases and 2 separate tax rates. Right? So when we are, as far as the rate goes, so here's our taxable base here. When you're doing 0.6%, 0.006 is the multiplication that you're going to use. So, oops. So $96. Was it $36 probably? 36 times 0.006 here is 24, and 1,000 is $6. All right, doesn't seem like that's not a whole lot of money. FYI, the most that any single employer is going to pay for a single employee for the year is $42. Okay, so that's the most that's going to be paid in food taxes for any single employee, that 42. For employers, they do not have to actually make the deposit of the food taxes until the cumulative amount that they owe reaches $500. They can just keep it on their books as a liability until January 31st when it is due, and then make the payment at the end of the year. But once this cumulative amount reaches $500, then they have to start making deposits every quarter for those food taxes. Okay. Questions about that? Okay. So, SUTA taxes is all. By the way, if you like working with Excel and spreadsheets, this is a great chapter for doing so. By the way, keeping track of this, you can put together an equation that helps you with the calculation. So if you're a spreadsheet nerd, this is a great chapter for that. Okay, so for SUTA, again, our wage base is probably going to be different. Our tax rate is probably going to be different. And for SUTA purposes, the tax rates, and I'm calling them tax rates, are actually called contribution rates. They vary based on employer as well. So what happens is the state determines what your contribution rate is going to be for the next year. In Iowa, that can range, well, I just pull up the, let me pull up the, convenient. I came right to it. All right, this is such a pain in the butt. Let's just use Iowa as an example. So as you can see, Iowa, the tax rate is anywhere from 0% to 7%. And the wage base is $36,100. So a lot more wages are subject to tax in Iowa than for SUTA purposes than for FUTA purposes. And you've got the potential for a much higher tax rate as well. Now, it depends on the company because well, first off, it depends on the industry that a company works in. There are certain industries that have a higher turnover rate. When there's a higher turnover rate, there is also higher number of employees that apply for unemployment insurance or apply for unemployment benefits. Just like any other type of insurance, the more it's used, the higher the rates are, right? You have car insurance, you get into an accident, and it's your fault, your insurance rates are going to go up because you're a higher risk. Same thing applies to the unemployment taxes. Certain industries are higher risk. Certain industries just naturally have higher turnover. Construction is one of those industries. That's a really good example. It's also very seasonal, right? So construction, and a lot of times employees in the construction industry during the off season will apply for unemployment benefits. So if you are an employer in the construction industry, you can expect that your contribution rate or tax rate is most likely going to be in the higher end, more toward the 7%. As opposed to other industries, accounting would probably be one of those, where they tend to have a lower turnover rate, right? So if there's a lower turnover rate, fewer benefits are going to be paid out. That puts less stress on the unemployment compensation fund, right? If you've got lower benefits being paid out, then you're going to get the benefit of a lower tax rate. So industry is one way in which that can determine what that tax rate or contribution rate is going to be. Another way is the employer themselves. So each individual employer may have a differing contribution rate, again, up to the maximum of 7% in Iowa, based on their own individual experience rating. Experience rating is how much have they paid out individually as an employer in benefits. How many claims have there been against them? So individual employers as well are penalized when they have higher turnover in the form of a higher rate. Okay, so it could be any amount within that. The state is going to determine what your rate is based on your industry and based on how many claims have been filed in the past, and if there's any amount that is in your individual fund. So what they do is they will, so they'll calculate how much you have contributed as an employer into the unemployment fund, how much has been taken out of that fund. If you still have a cushion in that fund, you've contributed more than you've taken out, then the chances are you're probably going to see a reduction in your rate. Kind of like if you're on budget billing for electricity. You know, if you're on budget billing, you've got a single rate that you are charged every month, and it helps to, you know, minimize any big fluctuations. But then at the end of the year, at the end of 6 months, they evaluate, have you paid in enough? If you haven't paid in enough over those 6 months, then your budget billing amount is going to go up in the future. Or if you've paid in more than you needed to, your budget billing amount is going to go down. So it's the same sort of concept. If the company has paid in more in taxes than what they've paid out in benefits, so they have a cushion, then probably their rate is going to go down. If they haven't paid out, if they haven't contributed enough, then their rate is going to go up to make up for that deficit, right? So for SUTA, and let's use Iowa as an example here. So again, we've got quarter one, and unlike the federal taxes, you have to pay these every quarter regardless of how much you owe in Iowa. You always have to pay. And you'll see, because the tax rates are higher and because the wage base is higher, the taxes that are paid at the state level, the SUTA taxes, are naturally going to be higher in most cases. So, so quarter one, again, we've got 2, 3, 4 employees. And again, so our base is 36,100. And let's just say that we have a contribution rate of 5%. Okay? Just making that one up. Quarter one, we have employee 1, 5,000. Employee 2, 10,000. Employee 3, 20,000. And employee 4, 25,000. Taxable wages for employee 1, all 5,000, right? All of these employees are going to be subject to these taxes. Well, I shouldn't say the employees. The employer is going to be subject to SUTA tax for all of these employees for quarter one, right? So 5,000, 10,000, 20, 25. So we add all of that up. What do we have here? 35, 45, 55, 60,000 times 5%. So $3,000. Did I get that right? $3,000 for the first quarter. It's a lot higher than our FUTA tax, right? Example, right? So let's look at quarter two. Same thing. We'll say 5,000, 10,000, 20, and 25. How much is taxable? All of it. All of it.
1,600.
Okay, exactly. Now we're getting into, we've reached that wage base because the cumulative amount is 40,000. Wage base is 36,100. So the amount that is taxable is the amount up to that 36,100. So 16, did you say 16.1? This employee?
11.1.
Again, so we're at 50,000. They had 25,000 before, right? So remaining was it 11,000? Yeah, like you just said, 11,100 was remaining. So there's our taxable amount. So what do we have here? 2,000 or 200, 6, 7 plus 5 is 2, 42, 200. Did I get that right? I did that in my head, so it could be wrong. So 42,200, 5%, 2110. All right. Third. I guess I should be consistent with this. 20, 25. How much is taxable?
All of them.
5,000 here, because we haven't reached, they've made 15,000 so far the entire year cumulatively, which doesn't reach the wage base. This employee has made 30,000 the whole year, which again has not reached that wage base, so all of it is taxable. This employee reached the wage base in the second quarter, so none of that is taxable. Same thing for employee 4. Right, so 15,000 times 5%, which is, what is 15 times 5? My instant math is bad. So, all right. We're gonna do quarter 4. We're gonna change something up. Employee 1 quit right at the end of the quarter, so no wages. Employee 2 still had 10K. Employee 3 still had 20K, 25K, and then we had employee 5 come in. We hired a new employee, and in the fourth quarter, they made, let's just say $10,000. I'm sorry for those of you over here. I know this is hard to see. I run out of room. By the way, when you get your evaluations, which is evaluating me, but also there's a place for comments. If you want to say we need more whiteboards, I would be ever so grateful because we need more whiteboards, especially in accounting rooms. All right, so taxable amount here, obviously 0 because there's no wages. Taxable amount for employee 2. So, sorry. 16,100. No, what'd you say?
6,100.
6,100. Explain the calculation.
30,000.
Right. Right. They were at $30,000 for the third quarter, made an additional 10,000, but during the fourth quarter they reached that 36,100 wage base. So only 6,100 of their wages are subject to SUTA tax. Nothing here, obviously, nothing here for employee 4. What about employee 5? All of it, right. So we have 16,100 times 5%. Oops. 805. Now let's look at this for FUTA purposes. In quarter 1, 7,000 of this would be taxable, right? 7,000, 7,000, 5,000, right? So we have 7 times 3, 21, so $26,000 would be subject to FUTA tax at 0.00. $156 for FUTA tax. That make sense? Okay. So they wouldn't have reached the $500 threshold. They wouldn't have to pay the FUTA tax at this point, but they certainly have to pay the $3,000 at the end of the quarter for SUTA tax, and they pay it to the state. Quarter 2, we look at the cumulative. So employee 1, we'd have 2,000. Right, because they get 2,000 of this 5,000 gets them to the $7,000. None of this would be taxable. None of this would be taxable. None of this would be taxable. They already reached the wage base in the first quarter. Quarter 3, we would have nothing. No FUTA taxes would apply because everybody has reached that $7,000 wage base. Right? Not until quarter 4 when we get this new employee who made $10,000 and $7,000 of it would be subject to FUTA tax. So we would owe $42. So we would have nothing due in quarter 3, but in quarter 4 we would have $42 because we have a new employee who's new with the company. Does that make sense? Questions? All right, let's look at this example here too. So we got Sumatra Imports. They're based in New Mexico. So this is where it's important that you know what state you're working with, right? Because those contribution rates, also as we saw, as I showed you in that chart, there are certain states where the employee does have a certain amount that they have to contribute for SUTA taxes. Sometimes it's for disability insurance, but they include it in the whole SUTA tax that they kind of keep it under the umbrella if it's a disability insurance. Like California has a state disability fund that all employees have to contribute to, and there's a percentage of their paycheck that has to go into it. It fits under the unemployment compensation umbrella within California. But so they're based in New Mexico. SUTA tax rate is 4.2%. Taxable SUTA wage base of $30,100 for each employee's earnings. Now, in this case, they haven't taken it and done individual employees. They've just given you the full amount here. So, and they've given you the taxable wages. So, FUTA taxable wages $109,500. SUTA taxable wages $298,700. That makes perfect sense, right? When you're talking about a wage base of $7,000 versus a wage base of $30,000 and what 100, makes perfect sense that SUTA taxable base is going to be higher because the wage base is higher. So all they've done here is take the FUTA taxable wages times the FUTA rate, and then the SUTA taxable wages times the SUTA rate. So you can see here as well, this is a really great example of, the difference in cost between these two programs, because for SUTA, this is where the benefits are coming from. This is where those weekly benefits are being drawn out of, whereas for FUTA, this is just for the administrative expenses. With the exception of during COVID, which was the first time that I'm aware of that the federal government actually did pay benefits to individuals. If you recall, there were some, and they were pretty generous benefits that the federal government was paying.
So is the 5.4%, is that a lowered rate regardless of what the state rate is? Because I thought it was, the 6% minus the state rate, or is it the 5.4?
Yes, it does matter. Yes, the state, the credit rate does matter with regard to the state rate, but I don't know that there are any state, I'm not sure that there are any states where it's actually lower.
Well, that says it's 4.2 and it still gave the 0.6%.
Right, but it's based on, so let's look at the 940 form. And it kind of comes out on the 940. Your adjustments, if all of the taxable FUTA wages that you paid were excluded from state unemployment tax, this is the full credit. Now let's see, I thought it was kind of more explanatory on the form. Give you much in the way of instructions on here. So, line 9 doesn't apply to FUTA wages on which you paid no state unemployment tax, only because the state assigned you a tax rate of 0%. So if your state rate is because the rate was assigned to you, then that would not factor into the reduction, the credit. But you have to, so if you don't pay any state unemployment, and this doesn't really, I don't know that this applies to anybody because I don't think there are any states where it's just, they don't have it. So we're gonna get more into the calculations of the credit probably on Thursday. Today's Tuesday, right? Thursday. And we'll kind of get more into that there. I'm just trying to see. So if you weren't required to pay state unemployment tax because all of the wages you paid were excluded from state unemployment tax, you must pay FUTA tax at the 6% rate. So if your state unemployment tax law excludes wages paid to corporate officers or employees in specific occupations, and the only wages you paid were to corporate officers or employees in those specific occupations, you must pay FUTA tax on those wages at the 6% rate. So if it's not considered taxable wages at the state level, but it is considered taxable wages at the federal level, then on those wages, that would be at the full 6% rate. So it would not, you would not get the credit reduction because you didn't pay any, but not because you had a 0% tax rate that the state applied to you. Like your contribution rate is 0%. You're not going to have to pay 6% at the federal level if the state says your contribution rate is 6%. But if you have individuals who earned what are considered to be taxable wages for FUTA, but they're not considered to be taxable wages for SUTA, then you do have to pay tax on those wages at the 6% rate. Okay, is that we don't get into anything that complicated in our assignments, but it's, so when you figured the tax before adjustments on line 8, it was based on the maximum allowable credit. Let's see, because you didn't pay state unemployment tax, you don't have a credit and must figure this adjustment. So if some of the taxable FUTA wages you paid were excluded from state unemployment tax, or you paid any state unemployment tax late, this is that late penalty, then you have to fill out a worksheet that's on the next page. Not here though. So there's a Schedule A. Let's look at the Schedule A. Do they have it here? So the Schedule A, if you have a credit reduction, if you're like in a credit reduction state, or you are subject to a credit reduction, then you would use Schedule A for that. Let's see, did they tell you? Credit reduction states for 2023, if you're interested. California and New York are credit reduction states. So that means they're in arrears with their repayments to the federal government with regard to food tax. And the US Virgin Islands. And you can see the Virgin Islands is a higher rate. That means they've owed it for a longer time. So we'll go through in detail the 940 as well and how that part works. Where'd I go? Maybe this. All right, so we've done that part. Let's look at what time do we have? 12:15. Let's pull up let's see if we can find a problem to work on together. So here, September, Manson Pay Corporation began operations in a state that requires new employers, I'll make this a little bit bigger, it's hard to read, of one or more individuals to pay a state unemployment tax of 3.5% of the first 7,000 of wages paid to each employee. Analysis of the company's payroll for the year shows total wages paid of $177,610. Salaries of the president and the vice president of the company were $20,000 and $15,000 for the 4-month period. There were no other employees who received wages in excess of $7,000 for the 4 months. Included in the total wages were $900 paid to a director who only attended director meetings during the year, $6,300 paid to the factory superintendent, and $2,000 in employee contributions to a cafeteria plan made on a pre-tax basis for both federal and state. In addition to the total wages of $177,610, a payment of $24.30 was made to the accounting company for an audit. They want you to calculate the food tax. All right, so this involves not only the calculation of the tax, but determining how much, taking into consideration all of that information, how much is actually subject to food tax. Okay? So, let's start with the numbers they give us. All right. So total wages paid of $177,610. Now they're calling a lot of things wages here that aren't really wages, right? So let's start with that. Salaries of the president and vice president of the company were $20,000 and $15,000 respectively for the 4-month period. So they began operations this year, so obviously they were only operating for 4 months of the year. There were no other employees who received wages in excess of $7,000 for the 4 months. Okay, so let's talk about the president and the vice president. First off, are the president and the vice president subject to food tax? They are, right. They're not directors of the company, they're executives. They are employees just like everybody else. But Included in that 177,610 are all of these wages. So for FUTA tax purposes, all of those wages are not subject to tax, right? We need to extract the amount over and above the wage base for each of them. Right? So we've got vice president. How much of the vice president's salary do we need to subtract from the total amount?
13,000.
13,000, right. So we need to get that out of there. This is the VP. Or actually, that's the president, sorry. How much of the vice president's salary?
8,000.
8,000. We're subtracting the amount over and above. Okay. All right. Everybody else didn't make more than $7,000, so all of those other wages are subject to FUTA tax, right? Included in the wages were $900 paid to a director who only attended director meetings during the year. Directors would not be included. That would not be salaries subject to FUTA tax. So we're gonna have to subtract that amount out of there. So let me say 900. All right. 6,300 was paid to the factory superintendent. That's subject to FUTA tax? Yeah. Yeah. It's an employee like everybody else. 2,000 in employee contributions to a cafeteria plan made on a pre-tax basis. What do you think about that? No. We need to subtract that amount because it's on a pre-tax basis and it's pre-tax for FUTA tax purposes as well. Okay. So this is the cafeteria contributions. What about the payment to the accounting company? $2,430. Yeah, that's a payment to a contractor, essentially, right? Yeah, so we don't have to subtract that. Unless, well, wait a minute. So was it included in there?
No.
Oh, in addition to, right. We don't have to add that in there. All right. So, for FUTA tax purposes, and lucky us, we got the same wage base for FUTA and SUTA. So if we didn't have the same wage base, these amounts might be different, right? All right. So we're going to add those up. $153,710. So FUTA. Doesn't say anything about a reduction or anything, so we're just gonna 06. And then for SUTA, our wage base for SUTA is gonna be the same. 3.5. $922.26. Let's see if I did this right. Yep. And then for SUTA, calculator. $53.79.85. Okay. Most of you will probably have a problem similar to that. The numbers will be different, should be different. But to give you an idea of what they're looking for there and what you have to exclude. Questions about that?
That did end up answering my question.
What's that?
I said that did end up answering my question.
It did end up answering your question? Okay. All right, let's look at another one here. I'm gonna leave that one for Thursday. Oh, this is a good one. This one's fun. So Marlene Grady and Pauline Monroe are partners engaged in operating the G&M Doll Shop, which has employed the following persons since the beginning of the year. So V. Hoffman, Drugan, yada yada, with the amount that they make per month or per year or per week. Grady and Monroe are each paid a weekly salary allowance of $950. That's not going to factor into anything. They're partners. They're partners in the partnership, so their salary is not considered taxable wages for FUTA purposes. The doll shop is located in a state that requires unemployment compensation contributions of employers of one or more individuals. The company is subject to a state contributions rate of 3.1% for wages not in excess of $8,100. So they have a different wage base for state purposes than they do for FUTA purposes, and they have a different tax rate. Okay? Compute each of the following amounts based on the 41st weekly payroll period for the week ending October 14th. Amount of FICA and OASDI and HI to be withheld as well. So you're gonna have to, yeah, you thought you were over, it was done. No. Still got that, still got the FICA and the Medicare tax. There may be some federal income tax stuff thrown in there somewhere too. So, all right. So let's take a look at each of these. How much, and this is fairly easy first off here, right? So Grady and Monroe are the partners. This is, we should be able, wow, there we go. No OASDI and no Medicare tax because they're partners, right? They're not subject to that. Those aren't considered wages for Social Security and Medicare tax purposes. All right, this is the 41st weekly payroll, and here are the taxable earnings for everybody. So we want to make sure, I'm pretty sure nobody's over the OASDI threshold. We'll take it by the number of weeks, so yeah, no, nowhere close. $16,084 has been earned so far, so none of these individuals are even close to the threshold or the wage base for Social Security. So we know how to do this, right? What are we taking? 392.31 times what? 6.2. Let's see, what's our, round your intermediate calculations to the nearest cent. All right. So 2432. What are we going to multiply that by? 569. All right, we're going to do that for everybody here. So 288.46, 1789. So we'll find out. Let's see. I'm going to say 1789. That's the proper rounding anyway. 418. I wish this wouldn't disappear every time I do this. Let's see if I can keep this up here. There we go. That'll work. Oops, not 60. Sorry. 260. So just in case you forgot what those percentages were, this problem will remind you. the employer's FICA taxes for the weekly payroll. So remember, when the employer is calculating this, they're gonna sum everybody up at once and multiply it by the appropriate tax rate, rather than just adding up all of these amounts that we've calculated. So, so 1240.77, 76.93.
That's the taxable payroll, so that would.
Oh, you're right. You are right. So 1240.77. So 17.99. All right. Now, amount of state unemployment contributions for the weekly payroll, and the amount of the net food tax on the payroll. Total amount of the employer's payroll taxes for the weekly payroll. All right, so this is where we got to go back and refer to our wage basis for each of these. So for state, and that's the first question, right? State unemployment tax, we've got a wage base of 8,100. And our rate is 3.1%. This is the 41st weekly payroll period. So we're gonna have to see where they were up to the last payroll. All right, so V. Hoffman, 392.31 times 40. They were at 15,692.40. They've exceeded the wage base both for FUTA purposes and for state purposes, right? So none of their wages are gonna be included. All right, so let's do this. So Hoffman, taxable wages. FUTA and for SUTA. So Hoffman. 0, 0. Let's look at Drugan. 288.46 times 40. 11,538 again. They've already exceeded both limits, right? Number SUTA, we're at 8,100. FUTA, 7,000. Fighter, 7,200 as of the last pay. All right, well, so this is as of the 40th pay. So this pay, how much of their wages are subject to FUTA tax? 0, right? None are subject to FUTA tax. What about SUTA tax? All of it, that whole 180, exactly. Because the 180 is not getting them up over the 8,100. All right, so let's look at Egan. Probably okay. 8,800. So none of it's subject to FUTA tax. And this was as of the last pay. None of it's going to be subject to SUTA tax either because they're already over that threshold as of the last pay. Now, Lynn. 6,400. How much is going to be subject to FUTA tax? All of it, right? They're still not at 160 bucks. That's not going to get them up to the 7,000 mark, which means also all of it's going to be subject to SUTA tax since the base is higher. All right, so amount of state unemployment contributions for the weekly payroll. We're going to calculate, so we've got 300 and, what is this? Why can't I do this? 340 and 160. 340 times 3.1%, and this is going to be times 0.6%. Sorry, I know that's low. you can watch me up here. So. 1054 is what I get for SUDA. Amount of FUTA tax, 160, 96 cents. All right, total amount of the employer's payroll taxes for the weekly payroll. All we're gonna do there is add the OASDI, the Medicare, SUDA, and the FUTA together. Okay. I get 106.42. And the moment of truth. There we go. Oh, they probably want it 88. I think it should be 89, rounding it properly, but.
Well, it was 88.4.
But the next number was a 5.
Yeah, but this one.
So that would round the 4 up to a 5.
But you round by the next number, you don't round all the way down.
You round by the end going up.
You round by the next number.
I know you, well, but you would have to round, you'd have to keep going. Technically speaking.
You're supposed to keep going, but like on this, it doesn't take.
Okay.
It's just the first, yeah.
Okay, okay. That's the one that I said, I think it's this, but we'll see. All right, questions on this? How are we doing on time? I don't know if we have time to do another one. That's kind of similar. So this one, I'm not gonna do it, but let's look at it. So partnership of Keenan and Kudlow, following wages during this year. We got a couple of partners, so those would not be considered wages for FUTA tax purposes or for SUTA tax purposes, so you would not include those wages. The supervisor, that would be wages. Factory workers, of course. Bookkeeper and maintenance, absolutely. All of those are wages. They owed $200 to Rudolph for work he performed during December. However, payment for this work will not be made until January of the following year. So Rudolph, the maintenance guy, that is not going to be included. It's not included until it's paid. Okay. And then the state unemployment tax, and the wage base is $9,000 then for each employee's earnings. Let me see if there's some others. One of these that I just kind of zoomed past, we're gonna go through, where'd it go? And I know you guys are gonna have questions on it. This one. So we're gonna go through this one on Thursday. I haven't talked about the reserve ratio and contribution rate yet. Reserve ratio and contribution rate are used to determine the tax rate that employers pay. So a lot of states use this system for determining how much, what the tax rate is going to be for employers for the next year. And the calculation involves determining whether or not they have over contributed or under contributed, and then how that's going to affect their future contributions and their future contribution rate. So this one, students have a lot of questions on this. This is one that I usually spend, a fair amount of time, maybe about half of the class period, taking a look at and going through. So we'll do this on Thursday. But feel free to take a look at it first, look at the book, see what it says. There are several steps to this calculation. Okay, there's a lot of things that you have to go through to get this, to do this one. So, other than that, I think we'll go ahead and wrap it up for the day. Anybody have any questions? All right, have a great day.